Biggest rally on the open this morning, then it kind of tapered off and then took off again after that Fed's announcement. Let's get to our panel for instant reaction. Joining us in our closing bell exchange, Martiak's been with us here from Peru Wealth Management. Josh Brown, a CNBC contributor from Fusion Analytics. Peter Eliades from Stock Market Cycles Management out in San Francisco. Kenny Polcari, CNBC contributor from O'Neill Securities, is here on the floor of the New York Stock Exchange, and Rick Santelli is in Chicago. Steve Leisman is at the Bernanke news conference in the room there. He'll be joining us shortly. What, is that it? That's all the people we could bring in here? Mark, you've been sitting here with us. What'd you make of what you heard today and the market response?
I thought the market response was very good, Bill, and I commend the committee. I think they're doing a phenomenal job at this point in time. Really, investor sentiment is rising. I think as long as unemployment remains at above 6.5%, I think the Fed will do everything to provide accommodative policy. Their mandate is to get the unemployment rate below 6.5%. And I think investors overall, at least my clients, and I sense that of other clients, they're feeling really good about the risk assets right now versus what might be going on in the economy.
Okay. Right, but I guess Kenny Polcari, you've been watching the story from the floor there. What kind of flow did you see as Bernanke was talking? Is there any feeling that anything changes for the foreseeable future?
No, there is not. And, we've actually been talking about this for a while. Everyone expected exactly what they got today, right? Especially in light of what's gone on in Europe. They expected Bernanke to come out and be this stabilizing force and to continue to reiterate his support of the market. And that's all well and good. But the fear is going to be, and more people are starting to talk about it, is how do we start to exit? And yes, the market feels great. And like your guest just said, his customers are feeling great. Of course they are, because the market's up 11%. I love that too. But at some point, when the Fed starts to pull out, the market's going to reprice. And that's going to be, that's the trick trade, right?
That is the question of when and how they will do that. Peter Eliades, last time you were here, you were saying that you felt your cycles work told you that we'd be peaking out sometime in February, but that, of course, hasn't happened. I'm reminded yesterday, a high-profile bear on Wall Street, Adam Parker, has turned bullish now, and his reasoning is that the Fed's impact on the markets is just greater than he anticipated. Is that what's going on with your work as well, that the Fed's monetary policy, very easy, has wreaked havoc with your analysis of this market?
Absolutely not, Bill. I don't feel that way at all. In fact, I think I called you 1 or 2 days after the interview or sent you an email saying that this is a long cycle. It's 25.3 years, about 25 years, 2, 3, 4 months. And so we've got to allow for a margin of error. It's been rather exacting over the past century, but the cycle actually goes back to 1836, Bill, 25.3 years. So we're within a 0.5% margin of error right now. To me, this whole Federal Reserve thing is fascinating because it's like, I don't think I've ever seen a greater disconnect between what's happening in our market and what's happening in our economy.
Exactly right.
Who said exactly?
I did. Exactly right.
Kenny, yeah. So,
let me ask you this. In terms of today, for example, mid-cap stocks hitting an all-time high, transportation's down. Do you read into anything in terms of this allocation and rotation that we're seeing in this market? Josh Brown, in terms of where we are in this bull market, looking to what's working now and what's working less than at the beginning of this?
I think the real key here is that a lot of the rally we've had has been driven by an expansion of PE multiple. In fact, this is probably one of the biggest PE expansion multiple rallies. And so what's come along with that is the fact that we're looking at things like housing that actually make sentiment better, make people feel better. Since the bottom in 2009, we've seen $1.5 trillion in household wealth come back because of housing. Last year, the stock market generated 400,000 new millionaire households. We're back to about 9 million millionaire households. So you can say it's the Fed, it's the Fed, it's the Fed, but at the same time, wealth is increasing. And the game right now is to say what is going to jar investor faith and confidence, what is going to force PE multiples to contract.
Right.
And frankly, it could happen out of the blue, but it hasn't happened yet. And we do have actual improvement in some pretty key areas of the economy, construction, et cetera.
Let me go to Mr. Market, Rick Santelli. Put them all together for us here. It's been very much a risk-on day. The euro's gone higher. The treasuries have gone lower in terms of price. I mean, what do you make of the market and the message today here?
Well, I look at a 2-year at 25 basis points. It really hasn't moved. I look at a 5-year at 79.8, which is exactly where it was before any of the Fed activity. 195 10-year where it was before anything. The 30-year at 318. Dollar index is marginally improved, a smaller loss, and stocks by far and away have held on to about 20 points a gain they didn't have. I don't know. Down on this floor, they say Ben's an honorable guy, but a little bit of a plagiarism going on. They really think that Father Time probably should get a lot of credit for the things Josh has been talking about and the legendary Peter has been talking about. But, of course, it doesn't really matter, I guess. As Ronald Reagan had on his desk, you can get a lot done in that town if you don't care who gets credit for it.
So the time is healing all wounds in this case.
I don't care who gets credit for it. Of course, I agree with Rick.
I understand.
You need the time. Time is the key. Any kind of balance sheet recession, delevering doesn't happen in 6 months, no matter what the Fed does.
Can I make a comment on the wealth effect?
And we've gone through a lot of delevering as well.
Hear what Mr. Legend says here. Go ahead, Peter.
All right, this whole wealth effect thing is very laughable. Yes, there's a wealth effect. The Federal Reserve was looking for that in order to goose the economy. So what did we end up with? We ended up with a fabulous wealth effect in New York City. Go there and try and buy a condominium.
Right.
In San Francisco, the financial center, go and try and buy a condominium. Where's the wealth effect in the rest of America? It just has not worked.
North
go to Las
Dakota,
Vegas.
Texas,
Is there a world
Utah.
outside of New York? Come on.
Energy-rich states aren't experiencing a wealth effect?
Of course they are.
Florida's not
Go ahead,
experiencing a wealth effect?
Yeah, no, they are experiencing
Okay.
a wealth
Tell me
effect.
what
This is
their
spreading across the
unemployment rate
US.
is.
He's the real deal.
Well, what are you saying, Peter, that there is no wealth effect? That when the stock market is going higher, people don't feel richer and they don't act
It's real
so?
estate is a more important wealth effect
Well,
than
but
stocks.
that's what the Fed was counting on. They were counting on the wealth effect because all they've done is create bubbles once again.
Right.
You thought we had a bubble in 07? Look what's happening now. Look at Manhattan real estate. Look at San Francisco real estate. Look at collectibles. Look at all the things that were bubbles in 07.
Right.
We started the deleveraging process. It started to work out nicely. Liquidation of debt. And now we're back to where we started.
And of course, Bernanke was asked about the wealth effect. Let me bring in Steve Leishman here. He just left the Bernanke news conference. Steve, he was asked about the effects of a bubble and whether or not there is a bubble in this stock market. What struck you from Bernanke today?
What struck me was I think there was a really important piece of news here, Maria, and it has to do with the creation, essentially, of a second litmus test for quantitative easing. And the chairman talked not once but twice about the issue of perhaps adjusting the quantitative easing amounts to go along with improvement in the labor market. And we had a kind of vague definition before of why they would bring it down. Now we have an even vaguer one as to why they might taper it down. I don't know if we have the sound, but I think it's pretty significant sound that the market ought to think about as to when the Fed might begin to taper its quantitative easing purchases.
We are seeing improvement. I think one thing we would need is to make sure that this is not a temporary improvement. So we've seen periods before where we had as many as 300,000 jobs for a couple of months, and then things weakened again. So I think an important criterion would be not just the improvement that we've seen, but is it going to be sustained for a number of months?
So I would say, Maria, it's a good time to start thinking about if the kind of numbers we've had in jobs continue for several months to come, could there come a meeting? Could it be May? Could it be June? Where instead of doing 85 billion, the Fed goes down to 65 or 40 billion. And now we're going to begin a very interesting discussion about how to calibrate the amount of QE with improvement in the jobs market, and a guessing process, Marie, will begin right now for Fed observers as to whether or not there's been enough improvement to begin to taper QE. So this is an important development today from this press conference.
Right, all right, and for what it's worth, Bill Gross tweeted out a short time ago that after that news conference, he felt that the quantitative easing, the bond buying, would be reduced sooner rather than later, even earlier than he had anticipated
Bill,
before.
I want to... One more thing is that I thought the Fed chairman talked more about the costs than I've heard him speak before about it. When I go back to think about what he said in congressional testimony, he acknowledged them, seemed to maybe wave them off more about the benefits. This was a chairman that sounded a little bit more concerned about the costs of QE down the road, and there was that addition about gauging the cost of it to that part of the statement this time around.
All right, gentlemen, I know we'd love to talk more, but there's never enough time, especially with such an august group as we've had today. Thank you all for joining us.
Thanks,
Appreciate it.
everybody. We appreciate it.